Good evening, everyone, and welcome to the PayFred webinar and the beginning of our virtual financial aid season for school year 26-27. And tonight's program is on paying for college and the FAFSA. It's the first in our series. My name is Fred Amrein, and we have a lot to cover. The last 2 years have been all about the FAFSA becoming available, and now this year we have the big, beautiful bill that will have substantial changes that we need to plan for. And it's a big change that no one's talking about. So we're going to cover some of that tonight, not a lot. The next program, which is in October, will cover more of that with the student loan and student loan repayment, because that's where the change is. We're going to cover a little bit of it tonight, but not a whole lot of it. So just as a point of reference here. So just a little bit about PayFred. What we provide is answers to student loan repayment, loan forgiveness, and college funding. We take a holistic approach to this. We're a quality partner for CFP. We do webinars for InvestNet, Money Guide Pro. That's one of the largest financial planning softwares. I'm a speaker for the Surgeon Accounting CE courses. We do presentations for NAFTA and National Association of Rural Agents, and I've been quoted in multiple magazines and national publications. And I have the most approved CFP courses on these topics because of all the speaking that we do. This just gives you an idea of our approach. We believe this is an evolution. It's not one point in time that we're making decisions. And now with the debt structure, it's even becoming more dependent on prior decisions. So that's really, really important. So planning for college and what you can afford. And now it's become so expensive, it really needs to be part of your total financial plan and retirement planning piece, because people are having their children later in life. And it's just, I have 3 daughters, and I can just envision what their timeline looks like. The college decision, getting to graduation, that's a big void that's going to become more important. The graduate school will now have the parents involved. And then once you've made all those decisions on how you structure the debt, repayment and forgiveness is now what you have to navigate. But you need to have a vision of what that looks like before you take on the debt. So that just gives our approach. And again, we have software, we have training courses for financial professionals, we do consulting work, and now a new benefit if you're an HR or a financial advisor that specializes in retirement planning, there's the new benefit called the Student Loan Assistance Benefit that was extended past the CARES Act. So here is the list of events coming up. There are the dates that you can see. It'll always be on a Wednesday night. It'll always be at 8 p.m. Eastern time. And tonight's the first one. The next one is going to be really, really important because that's going to cover all the debt structures and the repayment changes. So it's pretty substantial. We'll then talk about forgiveness. A lot of myths about that. That also is a big change. And then graduate school, that is another change. Parents will now have to be financially involved starting next July. So that will be a significant change. They do not need to be involved at all right now. And then once we cross over the first of the year, we then go into the saving for college and then understanding the award letter that when you're making your decision. So here's tonight's agenda. Again, if there's any questions, please type them in the chat. I kind of flip-flop, depends on if we're going to answer them during the program. Sometimes I'll stop just to give a break, and then or we'll answer at the end. We've already covered who is PayFred. We're going to then address the changes that the one big beautiful bill has impacted there, and the reasons for the changes. I think we live in such a political environment. There's changes that have been talked for years that we just need to do financially for the country. We can no longer keep on doing what we're doing. Then we're going to talk about the FAFSA timelines, understanding your position and financial aid, the basic there. What is the student aid index and how does that work? And then how do you make an informed decision? A lot of you may be in the very beginning process of this. The FAFSA is not available until October 1st. And you've already made visits to your schools. And the biggest problem that I see that's happening now that we need to address is that the system currently is built on a process of access and then affordability. With the new rule changes, what will happen is affordability now will be preference or preface the access, because what we could see is that the limits now in place, it will affect your ability to graduate from the school that you initially attended, because you may not be able to get the funding you need to graduate because of the private loans and the limits the federal loans have now. And then we'll address any questions. So the changes that are impacting college funding on the big, beautiful bill. So just want to explain the reasons here. The biggest change here is we're going to have caps or eliminations of the PLUS programs, and there are Parent PLUS loans and Grad PLUS loans. These were talked about. There were caps in the early 2000s. It's been discussed by both parties, and actually the plan that's in place is much more generous than what has been discussed before. We were talking that these caps were going to be in the 20 to 35 range initially per student. Now they are 65,000. Under today's rules, it's unlimited basically. So we'll give a little more detail there. But what the government needed to do is reduce exposure and require the borrowers to take a little more, better decision making in this process, because the federal program does not require any formal underwriting. Basically, if you have good credit or basic credit and you don't have a default, you can get approved for any amount. So it's called the cost of attendance limit, and that's what part of the problem is. Now, COVID has contributed to this problem, but now we have about 55% of borrowers that are in some form of non-payment of those who have to be in payment. And now with these new rules that they've put in place, the new repayment programs, the new forgiveness programs, the Congressional Budget Office and the Cato Institute, which a little is on the right side, but both of them came out with the same numbers. One was 19, one was 20 cents that we're losing per dollar lent. So when you look at us as taxpayers and you hear Social Security is going to go bankrupt and there's Medicare, Medicaid issues, this is kind of a hidden loser that we needed to address. And then what the whole process is, the complexity that's around this. We had 9 repayment methods. We're going to go down to 2, and that was also needed. So we're actually moving to I think a world that will be much more automated. The service levels for the loan servicers will probably change. We won't need them as much. And what the government was basically doing is eliminate their future risk of default, and specifically for the Parent PLUS loans. So that's all the PLUS loans, just parent and graduate PLUS loans. As I said earlier, the changes in my eyes this is significant. When you look at how people are going to have to pay for college and what costs they are. So you look at your highly competitive schools, they're in the $90,000 to over $100,000 per year. Now, when you look at what's going on here, the Parent PLUS loans, the student can only get under the current rules $27,000, and that's not changing. So what was happening is the debt was coming on to the parents, and we're seeing on the loan repayment side, once it started after COVID, we're seeing parents with $200,000, $300,000, $400,000, $500,000 of Parent PLUS loans because their children went to these expensive schools, and there is no financial consequence to that. They could easily get the money because of the way the Parent PLUS loan program happens. And then also on the PLUS loan side, you had the same thing going on with graduate schools. More and more careers required postgraduate degrees. It was just a building of bad decisions basically from the government and from us as a public. Again, we're limiting the Grad PLUS loans totally. That is a big deal. And then the limits, there are 2 different types of graduate loans. There was one that was just called the Direct Stafford loans. That was $20,500. That will remain the same. And that's per year with a max of $100,000. That's for a basic master's degree. So if you were to get an MBA, or if you're getting, like my oldest is a speech pathologist, or in education, some of the states require a master's degree after so much time in the public schools. That's what those will be classified of. Then there's another type that's the professionals. I'm not sure if we have all those. Typically, they're going to be your medical professionals, your pharmacists, your veterinarians, your lawyers are going to be that get the $50,000. Now, in both cases, many people are not. Those programs are more than $20,000 or $50,000 per year. This is where they'll have to go to the private side, and this is where parents will now be involved with the co-signing. So we're going to see an increased use of private loans, and this is where also the prior decisions that you make when you take that on the federal side, now when you go to the private side to get that funding, that debt number is going to be included, or if you co-sign for a private student for other children. So this is going to be a big change for many people, and you're going to have to really have a debt plan in place for this to work going forward. So here's the new funding strategy. When you look at it, what you have to understand, and this is a transition, we should have put this one other slide in. We had done it for our financial advisors. Right now, the federal government is funded, or the federal or the student loans, 92% of it is federal loans. So the private loans are a very small portion. Now, we rarely use the private loans because, and it still is true, there are some benefits to the federal programs. There's better repayment options. There's death and disability options. You have public service loan forgiveness and end of term forgiveness that's available to you, where the other problem is that most of the private loans have a 10 or 15 time frame. So also on the back end, your payment structure is a lot more expensive, your cash flow, because the federal loans, depending on your amount, can go out as right now to 30 years. It will go down to 25 in the new world. But this is why, typically we had managed that for cash flow reasons. What is now changing also, and we've always promoted this, is that you have to have a 4-year plan. And actually, in many cases, you have to have a plan, I should say, until 25, because more and more careers required postgraduate degrees. That being said, the goals now will be to minimize the private loans for your undergraduate studies so that you can maximize the opportunities when you have to go out to get private loans, or fund that as best you can. Managing your resources the best way. Again, the other issue that we see is prior decisions, or maybe you have your oldest child, and now you're going to take on this debt with this first child, and now your second child comes on board. Well, you've maybe co-signed for private loans, you have Parent Plus loans. Your debt to income ratios will be getting worse as time goes out, and so that will make the cost for your younger siblings more, because your debt to income ratios will not be as attractive when, a few years ago you didn't have a Parent Plus loan and now you do. So this is where there's a formal underwriting process, and that will then indirectly control the debt that parents and families will take on, because they won't get approved, or it will be extremely expensive to do that. And this is where having the information, the transparency to the outcome before you make your final decision will be more and more important. So that's an important part. And especially for high school seniors this year, you're the first class, or parents that will face this. You're the first class that will see this. The recent college graduates, the recent college freshmen that just entered this fall for the first time, there is a risk for them also, in the sense that the way the Big Beautiful Bill went in place, there was a 3-year runway. I think we have a slide coming up on that. And they will have an issue their senior year. It was at their degree, or 3 years, whichever is less. So the maximum timeout is 3 years. We could see a lot of families having a problem in their senior year. So this is the way we're approaching it. We've kind of called this the new 92,000 financing rule. When you're building your college list this year, I would highly recommend that you have 1 or 2 schools that you can finance with $92,000 over the first 4 years. That may include maybe going to a community college, go to the local state school here, and then go to the main campus here just outside of Philadelphia. So an example would be, we have a local campus for Penn State. Maybe you go 2 years there and then go to 2 years to Penn State main campus, just so that you can finance that. Because it's right now, I say on average between $14,000 to $20,000 per year for room and board. So if you can save that money and you're just going to get the same type of degree, that's important. So, how do we get to the 92,000? Well, the student, as I said earlier, can qualify for 27,000 over the first 4 years. Now that there's an annual and a lifetime limit with the student and the parents. So over the first 4 years, they can get 27. It's 5,500 freshman year, 6,500 sophomore year, 7,500 junior and senior year. And then for the parents, it's 65,000, and it's a $20,000 limit. So basically, you have 3 years at 20 and one year at 5. So when you look at now freshman year, when you're looking at resources, the parent and student get from the federal government is $20,550 in total. So this is where understanding the cash flows, and anything above that financing will then have to either have different resources or a different type of loan. Now, when you co-sign for a private student loan, that will also show up on your credit report, so that becomes a problem going out. Now, how is that a change from the current cost of attendance limits? The way the cost of attendance limit works, which is the way it is right now, this last year's class was the last class to benefit from that, and anybody that was in college, was cost of attendance, or the fully loaded cost of going to the school, less any financial aid you received. The parents could borrow up to that amount if their credit and everything else was good. The same thing happened with grad school. It was the cost of the program, less any financial aid. The rest could be done with a PLUS loan. So this is a big change where there's fixed numbers that go in these limits on an annual basis and on a lifetime basis. And as a result, if we're going to keep costs, maybe schools will react and lower cost and things like that, we're going to have to see an increased use of the private loan sector. As I said, currently they're only about 8%, maybe 9% of the total amount of debt of the $1.6 trillion of total student debt. So as I said here, the class of 26, which are your high school seniors, really are the first class facing these limits. And we've been talking to guidance counselors at the high schools, different college professionals, enrollment management people, and no one's talking about it, which I just find absolutely amazing. So you really need to do the additional planning here. Please spread the word, because here's what could happen. You'll get to this year, and you go through the current process. Again, many times your guidance counselors are not going to touch the financial aid side because it's so complex and so personal. Their job is to really get you into the schools. It's not to pay for it. And what may happen is you would then commit to a school, and you get the bill in, say, June or July, and now you find out that you only can get $20,500 and you $25,500, and now you need $40,000 as an example. Say you're going to one of those more expensive schools. You'll need to go to the private sector, but then what happens is, this is where that accumulation happens. It's going to make the future years much more expensive, and you may not even be able to get approved by the end. So that's the risk that you take. So this is a new planning priority that you need to take. I really think that affordability comes in front of the admission piece. It's a big change for guidance counselors for the colleges. So that's a concern of mine. The increased need for more transparency and strategies and your resource allocations. There could be situations where, maybe you have 529 money. Do we save this? And now maybe take the debt on the private side on the front end. So that may be an option when you don't have any debt to get a better rate. Maybe you take a home equity loan, or at least sign up for a line of credit. But that accumulation of debt, as I said, and if you currently have Parent PLUS loans or other debt right now, and this is your second or third child, you could have problems with that going forward, because those debts will be included in the private side that you need to finance. So let's talk about the process and the timeline for the FAFSA. Everyone should get familiar with the government website, studentaid.gov. They've done a really good job over the last, I'm going to say, 5 years with centralizing all of the different college funding and student loan repayment URLs. They all used to be separate, and you had to know each one of them, but they've centralized all of them, and they've done a really good job. That's where you'll complete the FAFSA. That's where all your loan data will stand. That's where you can apply for loans. That's where you can look at your data for repayment. This is where you submit your forms for loan forgiveness. All those things happen there. Now, to get access to that, you need to have what's called an FSA ID and password. Older borrowers may have those that replaced the FAFSA PIN back in 2015. So maybe you went back to school or something like that. You may have an FSA ID and password that you don't remember you do, but you should have one. It's a different login than your loan server. So again, this is new, and it's similar to a bank account username and password. And right now there's also double authentication, and it links together the Social Security number, the tax return, and the Department of Ed systems through a unified system. They all talk to each other now, and that's the automation I talked about prior to the big beautiful bill. So here are the process changes. Again, everything goes through studentaid.gov. Again, integration of the IRS data. So they're going to pick up IRS data. If you're on extension, it takes about 4 weeks for it to process if you file electronically to get to the Department of Ed. So if you're trying to do early decision or something like that, I recommend you look into getting that done. The number of people that need a FSA ID will depend on your tax filing status. So if you file as joint, then only one of the parents will need to file. But if you file married and separate for a variety of reasons, then the student and the parent and both parents will need it. If you're filed joint, then it's just the student and one of the parents on the tax return. So, and as I said, if you have your taxes on extension, this may be one of the reasons why you want to get that done sooner than later instead of waiting till October 15th. As I just said, this is your electronic signature. This is where you sign for your loans. You get access to the loans. And only the schools can see your financial information. You cannot even see the tax information that's imported. So that is a problem there. Everyone should complete the FAFSA form for both admissions and proper debt structure. So the student can get some loans. As I said, they can get that $27,000. The student has better repayment options, lower fees, better interest rates. The parents have, in the old world, they had better options, or they had some of the options, not all of them. And then what happens is when you complete the FAFSA form, you'll get a number called your student aid index, or SAI. It used to be called your EFC, or expected family contribution. And the way financial aid works is it's going to use that number minus the cost of attendance to determine what you're going to do. Now, they're going to be using your 2024 taxes as the basis. It's a process called prior, just if you hear that term. So you're applying for the 26-27 tax year or school year. Now, the way that works, or the easy way to remember that, is on October 1st when the FAFSA becomes available. So we're in 2025. We should have the 24 taxes completed. So next year we'll be completing this in the 26th year, October 1st, and 25 will be used. So it's kind of a lag. That's why they call it prior. And this has simplified the process also. This was done a few years ago. I think it was 2018. It was always a scramble every year because you had to get your most current tax return done. They try to get the award letters out as soon as they can. And what was happening is people had to get their taxes done in early February to get the award letters out at the right time. So this makes the process a lot better. Now, what you need to be aware of is if you have a change. So 24 taxes reflects some income numbers. If you've maybe lost your job or went on maternity leave or had decided to go part-time or whatever it may be, if you have a financial change or a one-time hit maybe you took for whatever reason, you would then have to appeal to each of the schools you're applying to. And then this year, the 25 taxes, I would recommend, and this is where we're going to talk about that in that February meeting, is get those taxes done. So again, if you're in at 25 and you've had a change, be ready to appeal. Just a quick thing on some of the changes with the FAFSA. The last 2 years have been an absolute disaster. Actually, last year wasn't too bad. There was delayed. There's FAFSA simplification had a big impact on that. We're finally returning back to the October 1st availability and the normal admission timeline. So things will be, I think, a little bit easier for everyone involved. There was a lot of 2 years ago when FAFSA, they missed it by months. And then last year they moved it back to December. and everyone was anxious because it was such a disaster that first year, because there was just a lot of misinformation, a lot of promises that weren't kept. So this year, hopefully, last year once we got up and running, it went pretty smooth. And I feel pretty comfortable that we'll be in that situation. There was minimal changes to the calculation this year. The biggest change is the small business and family farms will not be included as an asset for the parents. That's a big deal. We'll also see an increase in Pell Grant amounts. That was another piece of the big, beautiful bill. But then the bigger piece, which is it's related to the FAFSA form, it's really a pain, but these new loan limits will dictate, what you can afford and where you fall out for need-based aid. As I said, everyone should get their FSA ID and password to access the studentaid.gov website. You need to keep this confidential. It doesn't happen too much on the college funding side. It happens a lot on the student loan repayment side. They'll talk and someone will call and say, oh, you just need to give me your FSA ID and password. That's no different than giving them your social security number, birthday, and address. So make sure you keep that confidential when you do that. The contributors, again, that should be the student will need one. And depending on how you do the taxes, the parents will need one, depending if you file joint or separate. It is your electronic signature. It has double authentication now. That was something new back in 22. And then it is linking everything together. You need to have your social security. Now, where this becomes a problem for some people, and it's mostly going to be the women, I'd hate to say that, but they're the ones that have a change typically with their last names. I would highly recommend that you coordinate when you're getting your FAFSA PIN, is that you use an email address that's going to be continuous. And this happens a lot with the students. They're currently using their school's email address. I would highly recommend either they establish a new one using like a Gmail or Yahoo or whatever it's going to be. And then also they're going to need 4 questions and things like that. There's actually a article on our website, the process. So I would actually do that, but it links the Social Security there, the tax information, and the Department of Ed information. With the tax information, I would use that as your basis with abbreviations, how it appears on your tax return. So do you have your middle initial? Does your street have avenue versus AVE dot and period? They're the things you need to do that. I would make sure they're all the same when you do that. So now moving on to understanding your financial positioning and positioning to schools. I mean, this is a highly emotional decision for parents and students. There's a lot of peer pressure that comes in this process. I was talking to a few clients this week, and it's already started, and we're only back in school a few weeks. And that's a big deal. It's a big problem. And it comes from different places. It comes from their peer group, you as a parent, their other family members. It comes from other parents, their teachers. So it comes from a lot of different places. I'll be honest with you, the hardest part is typically around the Thanksgiving to Christmas holidays, end of year holidays, is where we're seeing a lot of family members. So there's a lot of questions. Johnny or Susie, where are you going? What are you going to major in? What schools are on the list? And you could get some results from early decisions. And this becomes a really difficult thing, especially if there's been some rejections there. The other thing, too, there's not a lot of financial transparency. This is where this is becoming more and more important. We're seeing, as I said, people over the age of 50 are the fastest group of student debt borrowers, and the repayment process is getting less friendly for them. And then if you ask, there was a study done with millennials, would you have made a different decision? And many of them would. So this is just making the right decision, having more transparency. And again, what happens typically when you go to those admission days is the schools will promote themselves, say, oh, if you, last year we gave out $50 million of financial aid. And we meet 100% of need. Well, the problem there is that my personal belief is there's not a school that meets 100% of need unless you're highly needy. And so what happens there is they get a sense of, oh, I just need to get in and I'm going to get the money I need to go. And that's not necessarily true. You have to have the numbers in front of you. And the schools only give you information 1 year at a time. That's another problem. That's partly because the way the federal system's set up. but they will only give you financial information. And now in these new rules, you're going to need to see all 4 years. Here's some alarming trends that you need to look at. Graduating within 4 years, less than 42% will be able to do that. About 30 to 35%, I can attest to that, will transfer. So here I am, doing this as a living. You would think I would know how to do this. My first two changed schools and changed majors for very different reasons, but all three have graduated, and I had one that was a Division I athlete. The goal here is to graduate on time. So that may require some summer courses or taking extra courses at different times. 50% will change major. So all this pressure to make this perfect decision, take a step back. It's an evolution, as I said at the very beginning of this, and the goal is to be productive, happy adults. And that is, there's a growth period that goes on here. So I'll give you the example I talk about all the time is my oldest. She wasn't sure what she wanted to do. And we went to this school, Penn State, and we left at lunch. She said, there's no way I'm going here. Fast forward about 6 months. She wasn't sure where she was at a local school, and she decided to become a speech pathologist, and it wasn't even on our list of career options. And all of a sudden, that's where she ended up going back and finishing and getting her master's there. She got a full ride for her master's. But these are the changes that you need to adjust to as a parent or an advisor as parents. You're working through this. 50% will change majors. But again, taking summer classes, all three of mine took summer classes, some at the local colleges and some at the community college at the very beginning. Again, because this parents are delaying retirement or bringing debt into retirement, that makes their financial retirement a lot harder. And these new loan limits will make it even more difficult. And this is a function of COVID and some of the things that went on with the SAVE program. But currently right now, this is the business side of government funding. 55% of borrowers that should be making payments are not making payments. They're in some type of forbearance or halt because of different programs. So how do you build your college list? Again, understanding the details of how your student aid index number is built. Everyone, when you complete the FAFSA, will get one number, but to create the right strategies and kind of avoid some of the myths, you have to understand that detail. Getting the list of schools, work with your high school guidance counselor, maybe working with a college professional. There's two organizations. One's called IECA. The other one is called HECA, HECA, and they're college planning professionals that focus mainly on admissions. Some do financial, but they really aren't. And same with your guidance counselors. They're typically not going to be experts in college funding. When I work with clients, we do not do any list building, or we just work with the financial side of you build your list, you have your list, and we help you understand how to pay for that. As we mentioned earlier, the new thing that's added here is the awareness. On your list, you need to have a school or two that's going to get you the 92,000 limit here, that you only need a total of 92,000 or around that number, so that you can go to that school and know you can finish and have the money to graduate. Understanding your position both academically and financially, being able to compare the award letters. So that's part of our tool that we have here. You'll be getting multiple things and then making that decision. It's a value decision for me. So, one school may be closer, may have a better campus, but the other program gave you more money, and it maybe is just behind the other school in the type of recognition it has for a certain major. Make a decision and then graduate on time. This is what you should try to do, and have that in mind as you go through this process. So to make the right decision, you have to consider these three things: the academics and major. So the demand, how good is the school at that major? Does the major that you're considering or the career require a postgraduate degree? So an example, as I use my daughter, the oldest one, when she made that decision to become a speech pathologist, we knew that she needed her master's degree. I had two other children to pay for. We had a discussion and said, listen, the master's is going to be on you. We won't be able to help. So, those things have to happen. And I said at the very beginning here, the new world, because of those type of situations, you have to look at what your child looks like at 25. Well, how much schooling are they going to need to get to their desired career? So like law school or medical school, what does that mean? How's that going to be paid for? Campus environment, big school, small school. I mean, here's where, as an example, the state school may look really attractive, but your child's been in a small private school their entire life. They're going to go from a classroom of 15 to a classroom of 300. Will they be able to adjust? Because now if you've saved that, extra $30,000, $40,000, you then are there an extra year just to graduate. And then the financial aid process. What can you, what will you get? How much money will you, net pay? And then how do you use that system, the financial aid with the student loans and things like that. So here, just to address some of the common myths, take all the assets out of your child's name. This is where understanding the detail of your student aid index number is important. Everyone says, oh, take everything out. We'll see how that works in a second. But basically, assets in the child's name is worth 20% or factor into 20% in that student aid index number in the calculation. But if you're going to a state school, the parents' number is higher than the cost of attendance, then it's not going to matter. So that's, again, we'll be able to see that a little bit more, but that's a myth that is not true. The other thing is the schools are need blind. Personally, there's not a school in this country that's need blind. The process that they use is called enrollment management. It's not explained to you, but it's the blend of how they make what students they want for a variety of reasons, because they have so many seats to fill in the business school and the pre-med program and whatever it may be, and they want so many minorities, so many first gens, and so many from each state. This and the 100% of need is often promoted, and they use the words very, very marketing like. So we haven't had a tuition increase. Well, that's a tuition increase. They mean tuition. That doesn't mean that the fees and the room and board and other things, it's not. We take the word tuition and say, oh, that's the total cost, and they literally mean the tuition. As I mentioned, the marking of the financial aid amounts, the schools will do that often, as I mentioned earlier. And then there's some organizations and professionals that will use life insurance and annuities. You need to be very careful in those situations. That can be, if it's not part of your total financial plan that works, you need to be careful. So if that's a solution just for college funding, you need to be very, very careful in that situation. So also, when you go through this process, financial aid process is not just the only thing you need to do to ways to save money. So understanding the expected financial aid position that you're in, what's your student aid index number? There's tax savings and credits. So you can use 529 plans. Some states have benefits to do that. You may qualify for the American Opportunity Credit. There's things here that you can save thousands of dollars easily and maybe meet that, say you're $100,000 and now you can count on, 4 years of $2,500. So that's a tax $10,000 that you don't have in your pocket that you now will have. You'll be paying less in taxes. Things like the college selection process, how you structure the debt, and then the outcome. How are they going to pay for this? What's the job they're doing? Is student loan forgiveness a possibility? Let me just make one statement here clear, is that student loan forgiveness is not really an option to fund undergraduate study because of the way the calculations work, unless you're very, going to be making a little amount of money. So, that shouldn't be part of the plan. Now, that can be part of your total funding plan for graduate school, but for undergraduate school, it typically does not work. So let's go and understand how the financial aid process works. The cost of attendance in our numbers way, that is fully loaded. So that we're assuming that everyone's going to do room and board, at least when we run the initial numbers. And that's going to include the tuition, the fees, the room and board, the books, travel, and living expenses. That's why we do that. And that's on the website. Sometimes it's difficult now in our system. We do that manually. We have our own data. We visit all over 1,600 sites to get the right numbers. They're all up to date. And so that makes it a little bit easier. Some of the systems are out there, buy the data, and that can be anywhere from 6 to 18 months old. And then you're going to fill out the FAFSA form. You'll get your student aid index number, and then that will then determine your financial need. So That's how that game gets played. And then if you don't qualify for need, you're a full pay. So if you're more middle class, again, depending on what school is on your list. So you may have your middle income families where they're not going to qualify for aid at the state school, but they will at the private school. So again, your situation will be different for each school that you list. As I mentioned earlier, there's 4 parts of the student aid index number. You have the parents' income and parents' assets. Again, the rules are different. So that's important. As an example, why people made that statement that I talked about the myth before is that the parents' assets are weighed at 5.64% and the students' assets are weighted 20%. So if you have assets there now, what happens is when we do the analysis, the parents' assets and income number, the parents' student aid index number by itself is a number. And if that number exceeds the cost of attendance, then actually, if the parents have an affluent or affluent, we actually could be putting assets in for tax reasons to lower their cost. So understanding the federal details here, this is the federal methodology. There's another method that's called the institutional methodology, but you're going to be managing your adjusted gross income, the taxes you paid. Now, what's really important is how you save for retirement. Contributions to your deferred retirement on your 1040 will be included in the student aid index number. If you use your 401k, 401(k) and make it a pre-tax adjustment, it will not be included. So this is that integration to the IRS, and everything is really coming off the 1040. So that's important. So if you have a choice there, typically with your company benefit programs, they allow for a higher limit, but that is something that's really important. I mean, if you have a rollover from a prior employer, so you do a rollover from a prior employer in that given year. So say you had one and it's on your 24 taxes. We haven't seen the calculation in the systems. There were some problems before that. Again, you cannot see that, but if your number seems higher than you expected, that could be the reason if you had that event. So again, we're using 24 data. Now on the parents' assets, it's a little bit different. It's going to be use your checking and savings. It will be for all of the children you have the college plan for. So example, if you have a 529 plan for 2 children, both of them together, both of them will be need to report it for both children. So say, each of them, one has 50, one has 40, you'll put 90 in there. Now, say that 50 and 40 were owned by grandparents, then that would not be reported. So that's an important, at least on the federal methodology. As I said, they'll be weighted at 5.64%. And then we get through that part of it. On the student side, the same thing happens there. You could see a situation, especially for graduate school, where some of the scholarship or stipends are given, could be added back in, checking and savings, and they're weighted to 20%. There's no allowances there. So that's how that will work. So here's just an idea of what the numbers and how we look at it. So in this case here, we can see the parents' income. This is a family that made about $150,000, had some assets in the 120 range, and we convert over, and you can see the parent student aid index. This is important to understand this. Now, you can't get this under the FAFSA system. This is our own system, our pay for ed system. We can see that the parents' student aid index number is 35,931. If we were applying to, say, a small state school and our that cost was $30,000, and we had, the student had 20,000 in their name, that's where it converted over to the 4,000. This is where if you're applying to that $30,000 school, taking the assets out of the child's name, outside of the tax things and other legal issues that you may have, will get converted over. There'll be no benefit there. The student aid index number, because your cost of attendance is less than the parents' student aid index. So again, knowing the cost of attendance for their schools and the parents' student aid index helps you understand what strategy you need to take at each school. Now, there's a second methodology. So we saw that here. In our system, we list the schools to make sure you understand what number they're using, because a lot of your schools that will be saying, oh, we meet 100% of need or we're need blind are going to be this. So you'll be able to see this. Now, what's the second methodology is called the institutional methodology. Some schools have their own methodology where you go on their website and fill out the information. Many schools use a process called the CSS profile that's run by College Board, and that will be a unique number for every school. So some schools will include numbers from a divorced couple, from the non-custodial parent. They'll ask what cars you drive. Again, each school can have their own process here. So that number here, but you can see the difference here. So they meet 100% of the need, and say it was one of the elite schools that said that, but they're using an institutional methodology. They mean to the 62,000. You still have a gap here. So this is the other problem that you need to be aware of. You'll be able to see when you complete the FAFSA on the FAFSA summary report that you'll be able to see that 39 number. What you won't be able to see is when you complete the CSS profile or the institutional methodology, what number is that final result. So something else you just need to realize when you're making that decision. Just going to quickly look at it here. I'm going to quickly go over to, we already talked about some of that stuff, is the institutional methodology. As I said, here's the biggest difference: home equity, assets in other children's names, cars you drive, business assets, things like that will be included here. The non-custodial parent, which on the FAFSA is not included. So these are things that are important, and when you look at that calculation. This is how, as I mentioned earlier, the enrollment management piece. So the blue dot is the student, and this is part of the chart that we offer here in our software, is the horizontal line, and everyone's familiar with this. Oh, that's going to be a reach school for me. They're talking about the academic acceptance here. So they're hoping maybe their teacher recommendations or the extra activities they've done at school will get them over that hurdle. But what's not explained to parents is just like the SAT, ACT scores, they have an average package that they plan to give to each child. And that's part of, that will be different for every child, but there's a weighted average number that they get. So an example here is the average package of the school was 16,000. The blue dot is on the right-hand side of that. If you look at the bottom here, they have a need of 19.5. So academically, they're above the horizontal line, which is good. So that's a very attractive student from an academic standpoint, but they have financial reach. We're not saying not to apply, but this helps you understand what you should expect. And so again, there's so many factors. There are some schools have up to 300 boxes in this matrix, and some of the schools will use up to 60, 70 different factors to put you in what box you belong in. And this is how they make their decisions based on your need and things like that. So this is where the admission process, and a lot of times when we get to the award letter section, this helps people understand it better. As an example, say Johnny is, not as smart as Mary, and they were next door neighbors. And Johnny, they apply to the base school, and Mary has better grades, she has better SAT scores, but her parents have gone to college. Johnny's parents is a single parent and is the first gen to go. Well, he gets in and gets a $10,000 scholarship, and she doesn't get in. And why did that happen? Well, in their matrix, they were looking for first gen, single parent in a certain state, and maybe he was applying to business and she was applying to sciences, and all those factors come into who gets admitted and how much money they get for a variety of reasons. Again, that single parent could be, their SAI could be lower. Again, these are the complex things that you don't understand that become confusing, especially after you receive the award letters. So you can see here, this is a simple need analysis. So if we're looking at college, and again, your student aid index number will be the same at every school unless you do an appeal. So here, the parents have completed the numbers. It's 25,000. They apply to a school that's 20,000. They will not get any need. Again, this is understanding, remember, cost of attendance minus the student aid index equals your need. But because they complete the FAFSA form, they'll be able to get the 5,500. That's that first student number. Now we go to the $40,000 school, and now we have the same number, and we have need of 15, but they get a package of 12. So that difference there is called the financial gap, the $3,000. But in that school package, there was 12,000. Some of that will be loans, maybe work study, and some of it may be free money scholarships or things like that. So it's not always free money when you get that school package. So Again, understanding how the calculation works and what you can receive. But another reason why you need to complete the FAFSA form is to qualify for those student loans. So understanding the importance of the 4-year approach, again, understanding the total cost. Again, the schools will only give you one year at a time. Multiplying the 4 years by 4 it can be misleading, especially now, because you won't be able to do that with the debt numbers. With now, we don't have the costs of attendance loan limits. It will impact the net cost of other family members. So that's really important. We do a timeline. There's 2 timelines there to understand. We used to have what's called the multi-child discount. That no longer exists. So it is per child. But you as a parent need to look at when will your youngest graduate and how old will you be, because that's going to impact what your retirement is going to look like, because it's gotten so expensive. Again, when you transfer, you want to try to prevent transfers if you want to do that, because it may affect the awards. And understanding the what and how. So our process, we want to show you what you're going to be paying and then how you're going to pay it. And that's important on the front end when you're trying to decide what's a good fit. You have the other subjective things like your campus and your academic strengths and things like that. But then the ability to pay is going to be really, really important as we go forward. So this just gives you an example of seeing the list of schools. Again, your list should include, in your senior year, it should include the schools you want to go to. But I would tell you again, remember the rule of 92,000, how that will work. This family has 30,000 in a college fund. We don't care what it's in, and they can afford 12,000. Maybe they're paying current tuition of $12,000. But again, we're working through the cash flow to understand what our debt structure is going to be at each school in that process. This is the what and how, as I said. Now, 2 things are showing up here. Here, the list price of the school is $309,000. We did qualify for some aid and things like this. This discount, so basically we got a third off, comes down to the 207. And here's our 30 that we just showed you. Here's the 4 times the 12. The student's going to take the 27, and now we have a 102 funding shortfall. So we're over our 92 here. Now, could we do a home equity, or are we going to do the private? Is this the dream school that we need to go to for a variety of reasons? I don't know. But this is the process of showing you in total what's it look like and how to manage that correctly. This is what we call our what and how. This is our formal process. The graph I showed you, this is the enrollment management process. So example here, academically, the student looks very, very attractive, very strong in their academics. But again, the horizontal line here, we have a slight financial reach here. Again, as I said, I'm not telling you not to apply. What I'm saying to you is I just want to add some transparency and have some measure of expectations. As I said, that example where, just by what you're applying for as business versus science, the rules, the schools are looking at all that of how many seats. It's like, an airplane ticket almost in some cases. Then understanding the details by year. Again, this will become more and more important on the financing side. The red is our funding shortfalls. And this is, in the past, it was a little bit easier to do that because we had the cost of attendance limits on the Parent Plus loans. Under the new process, we're going to have financing to show you how to do this, but it's important. So you can see there's the 30, there's the 12, here's the direct staff for loans, and then here's our funding shortfall as we go out each year as it will go out. And now, remember, if we start borrowing more money each year, if we only can borrow up to the 20,000, what we may come into a situation where we're over that limit, we're going to have to go to the private side, and our debt to income ratios are going to get worse. And even if we co-sign it, so a co-signing is going to still show up on our credit report and impact our debt to income ratios. Other factors you need to consider are your graduation rates, your admissions rates, and your numbers. Again, if there's any questions, I know we're covering a lot here. Please type them in now, so we're coming near the end of the program. So how do you make an informed decision? Again, creating a customized cost of attendance, understanding the cost, understanding the travel, understand the parent's cost. So the cost of attendance includes only the student's cost. So now if they go far away, the parents are now going to have to take a plane ride. They're going to have hotel rooms and things like that, where if the student's within driving distance, maybe you don't have to, you can do that a day and go up and back if you want to. So again, another thing also in your planning for your different schools, I would highly recommend you find out the methods of getting home in case of emergency and what would it cost. So you have a death in the family or something happens. How do they get home as fast as they can and how much will it cost? Should be part of the analysis of what you need to do. Understanding when you get this, again, we'll all cover this in that March meeting, is understanding the difference between need scholarships and merit scholarships. Really important to understand. Typically with a merit scholarship, there's a separate letter. There's certain rules that you need to follow. So there's certain GPA. Again, on a need basis, as if maybe your income goes up and down, you're in sales or something, that will have an impact. Understanding your career path and how much education you need, how much demand is for that career. So that I want to do this certain job and maybe that sounds great, but there aren't that many positions, or how do you get into those positions and what type of education we need to do that. And then, which is going to become even more important, is the debt planning side. So once this is the acceptance, and we're just going to blow through this, the system will then, two parts. We saw the admission side, that was the college list, but now once you get your award letters, we start putting in all that detail, and then we start sorting it by the most cost effective. And here's where you can see the total debt that you'll be doing. So an example would be here, Penn State at University Park, for this student, they're under that $92,000 that we talked about. Here, they would be over the numbers here. And these the right places? Again, let's look at this. Classrooms of 300, classes of 20, 30 people. So where is their child going to thrive, as an example? So what do we need to do to improve the process and make it less stressful is just add transparency. I mean, it's a very stressful process if this is the first time through this. It will become more difficult, especially this year, because we're not hearing about this change on the financial side. Hopefully the things that we've added here, again, make your college visits, go to the college fairs, talk to, alumni of the school, but get a level of expectations. Planning for graduate school will become more and more important. I ask that question all the time, because if now you hear what I'm talking about, the debt structures, and say you've done a good job and have, say, $200,000 saved, do we now pay and go to the least expensive school or less expensive school? So maybe go to a state school versus those more competitive schools, and then have money left over for grad school. And that way we're not completely loaded with debt at graduation or at 25. And the whole thing here is to avoid the excessive student debt, and really it's involving to trying to stay within the federal debt so that your debt planning can be maximized for future. When you go through this, again, how do you save time and money? What we help you do is the privacy, organize it all in one place on the financial side. Again, this complements your academics. I think it's really important that you engage the child. The way we've built our system, and we have a viewer function where you can give them access. They can add schools, and it hides your information when we build a student aid index number, so they won't be able to see that. The whole deal here, again, for me is not maybe avoiding excessive debt. Each person's going to be different, but managing the debt so it's manageable is maybe a better way to have as a goal, because every person's situation is going to be different on how much money they've saved, what their student aid index number is, what schools they really want to go to. It's similar to your taxes. Every situation is unique and what you benefit. Maybe you qualify for American Opportunity Credit and someone else doesn't. These are all the things you need to work through. So the Pay for Ed system, I showed you some of the screens in the system. There's help videos, there's coaching videos. The video library has all these recordings of our programs, last year's programs on file until we'll put this up as soon as it's up there. We have our data that's, we just think is really good because it has the same information that the schools have. We call the schools. It has some other things there. If you're now looking to do loan forgiveness, some other help there. And then we also do the private consultations if you need that. So hopefully there, Amy's asking questions. What are the costs of your services for average parent? So the average parent right now for the student for a college plan is about $500 for that first things. And that includes we work on an hourly basis, to be honest with you. And what that includes is the analysis. We'll have a fact gathering process. There's an input sheet. We'll need your taxes, the college list, maybe some information on, say, a 529 plan. Maybe a grandparent's going to help. And then we sit with you. You'll get access to the tool. And then we'll actually do a hour and a half meeting with the client, between an hour and a half with the client, and go through all that. Then there's a 2 or 3 page report, kind of almost a to-do list of things you need to be aware of. And then if you need additional help after that through the award letter or things like that, then there's just on an hourly basis. So that's how that works. If you have student debt, again, we'll bring this up next week, but there's a whole set of transitions. I would highly recommend that you read a few articles or sign up for a newsletter. I'm not sure if most probably are registered, have already gotten the newsletter. But on our Pay for Ed website, at the very top, go to the blogs. There's a whole set of refreshed and new articles on the One Beautiful Bill. Also on some of the things like there's how do you get the FSA ID, 10 mistakes that people make with the FAFSA form. We just issued that newsletter out. If you're not signed up for the newsletter, I'd highly recommend you do that. Amy, can parents work with you directly or without? Yes, they can work with me directly. So again, we work with financial planners. This has gotten so complex. Think of this as on the medical practice side. It's similar to this. You have a general practitioner, and we're the cardiologist or the orthopedic person. This is all we do. We don't sell any products. There's no, we have no financial gain. There's nothing presented to you that's, we're getting a commission from or anything like that. So it's all just advice. And that's why we're on an hourly basis. So the net price calculators, according to FAFSA simplification, they were supposed to update this. Now, this analysis is a little bit old, but University of Penn has done a study, and that's going back to 2000, and I think it was 19. It could have been, it's 2019, I think. And the accuracy of the net price calculators were horrible on the websites. So they're not up to date. I can just tell you the amount of work. I don't do it. My wife's the one that does the data for the colleges. And the process to go on the school's website to get the right cost, and again, the average cost. What's happened on the average cost side is that all the programs have become a la carte. What I mean by that is the pre-med program versus the business school versus the liberal arts, all different fees, tuitions, and things like that. Then you add in, room and board. So you're going to be in the dorms, the suite, which meal plan you take, the 15 meal plan, the 18 meal plan. It gets to be very, and that's why when you do the award letter section, we saw that one at the end here, we break that all up in pieces. So you can see that because everything's unique. Your travel could be, now the schools on their award letter use the averages, unless you can justify a difference. So an example would be, where you'd make an appeal if you had a change of your income, as we talked about earlier. But another situation could be maybe your child has a medical problem and they have to come home once a month to see their doctor for whatever reason. You could talk to the school and say, hey, we have added travel expense because of this, but we want to come here. Schools, that would be a reason where you could then make an adjustment. So the net price calculators, I'm still kind of leery. According to the FAFSA simplification rules, they were supposed to be more compliant and more up to date, but we haven't seen that to be the case, at least at this point in time. And especially with the COVID and now with this big, beautiful bill, it's going to be interesting what happens. I think we'll see some price reductions. There was a process that happened a few years ago that's called tuition resets, where right now they're discounts. So everyone gets like the $5,000, $10,000, $15,000 scholarship at certain levels. And it's really a price discount. And it's a feel-good scholarship. We could see it, and there was a wave of that about just before COVID. Quite a bit of schools were using that strategy. Another thing which I didn't mention with the big, beautiful bill, another reason why that may happen is we may see that reduction of scholarships need what we call discounts, basically, is the schools are going to be held more accountable on the loan repayment side. it's kind of funky how it's going to work. I'm not sure if it's really going to work, but there's much more awareness now on the repayment side that the schools will be held accountable. Another thing indirectly that the market will drive is that because people will be turning to the private lenders for some funding, I don't know to what extent, what will happen is you were in, a school you went to school A and graduated and you were either late or whatever. And say there's a group of people that do that. So that, they have a group of graduates from school A that are defaulting on their loans or late pays. What we'll see is those lenders will have a tendency maybe to either not go to that school or deny you for a variety of reasons, even though your credit's good, because they know that either program doesn't put out good people or they don't make enough money. That's going to take a little bit longer time, but that's something else that's going to be happening too, where it will be harder to maybe get financing when programs are not as good as they should be. And we should maybe also see a reduction of the various programs just because the schools are going to have to make adjustments. It would not surprise me in the next few years to see a significant amount of schools close or consolidate. We're already started to see that now because of these new limits. Schools will not, or parents will not be able to get the money they used to be able to get going forward. We are here a little bit over time, but are there any other questions? Just give it a second. Again, I would tell you to sign up for the newsletter on the Pay for Ed website. And there's our phone number and our email address. So I do appreciate your time today. And I'm sorry that we went a little bit longer than expected, but we had a lot to cover. And if we don't have any more questions, thank you so much for coming and good luck. Have a great day.